Investors have been watching their portfolios get hammered in recent weeks, and they're wondering what should they do. There's probably a good reason why stocks are going down. I've actually made a couple of videos on this, and they're wondering, should they be buying, selling, holding, panicking? My personal view is that Mr. Market is there to serve you. That means you need to understand what is the intrinsic value of a business, what are the fundamentals, what's the optionality, what's the growth prospects. I talk about all this type of stuff and more with individual companies. I have been buying individual stocks, and in this video, I'm going to talk about one of the companies I have recently been buying and why I like it. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I did own stock in Alphabet, or GOOG, Google Stock. And so, look, as I previously called out, the investment world is hyper aware the Federal Reserve is starting a tightening cycle. So I'd argue everyone's on one side of the boat saying, we're in this tightening cycle. On its own, this isn't a catastrophe, but when overlaid with an expensive market and the prospect of a potential U.S. restructuring or currency debasement, it really gets investors nervous. So I did a whole prior video talking about this risk and how it does create much greater risks than most folks are even aware of. So I'd recommend you check that out just for having broader context. So my takeaway was that you should let Mr. Market serve you, as I already called out, and take the volatility as an opportunity to deploy capital little by little into the best dream investments that are out there. I'll talk a little bit about portfolio management towards the end of this video. But one such company, I'd argue, that meets that checklist of a dream investment, in my opinion, is Alphabet, or GOOG stock. You have a strong, if not unrivaled, value proposition when it comes to online advertising, a diversified global revenue base. Over 50% of their revenue is ex-US. So, for example, if there is a currency crisis in the US in the future, or there's a currency debasement, net, it would actually benefit Google shareholders. They have a very strong balance sheet with over 150 billion plus in cash. So that puts them in a really strong position to take advantage of share price weakness, as they've already been allocating over $10 billion per quarter for buybacks recently. So that is a nice position to be in. They have smart capital allocation. I already mentioned the buybacks, but they also have some incredible moonshots that they've been working on. And critically, especially for this channel, a reasonable valuation. While many investors mistakenly believe that all big cap tech stocks are outrageously expensive because their stock prices have gone up, the reality is that much of their performance these last few years was actually driven by very strong underlying fundamentals. This wasn't just pie in the sky valuation expansion. This was driven by very real business growth. For example, as you look at Google's third quarter 21 earnings results, they posted 39% growth on a constant currency basis, 41% on a revenue basis growth in the third quarter 21 versus third quarter 20, 32% profit margins, and near record earnings. I mean, this is incredible. While this was a slight, this growth acceleration did represent a slight benefit from COVID reopening / rebound, the reality is that the prior year, they were still growing at 15%. So this is just a beast of a company. And their growth was really diversified across the board. Yes, search is clearly one of the best businesses that has ever existed. But YouTube is also growing, 40% plus, as is their Google network, while Google Other, which includes the Play Store, hardware, and subscriptions, was up like 20% plus, and arguably has a monster runway. For example, their hardware strategy might even put them at a further competitive advantage in the future. So I'd argue not yet with their hardware, but there is this real potential for them, in the years ahead. For example, what if they constantly reinvest their lucrative ad profits into building and supporting the best darn phones that they can make, constantly innovating, constantly layering in, let's say, new artificial intelligence within these phones, and they sell them at break even because they don't care about marking up a huge profit on their hardware, because they want to lock in, let's say, future users, future ad revenue. What if their entire hardware model effectively becomes a neutral cost of customer acquisition? I mean, that could put them at a competitive advantage in the future. And honestly, their phones just keep on getting better and better, it certainly looks like. Now, meanwhile, that's just one of the bets that you sort of have going on here. They have Google Cloud as well. Now, that's operating at around $2.5 billion loss run rate. But look, they continue to take market share, and it's growing 40% plus, while also winning many of the top companies in several core sectors like telecom, media, entertainment, retail, software, auto, etc. So there's a lot of winning going on across the company. Google Cloud is just one of their businesses. Management is also not shying away from huge moonshots either. They're rapidly expanding their autonomous robotaxi service, as Waymo recently launched in San Francisco. And Google's other bets also include autonomous trucking. This is also under the Waymo umbrella, which recently launched a new partnership with JB Hunt as it autonomously moves freight around Texas. I mean, just think about the potential there. Their AI pioneering segment, DeepMind, has made a critical impact on our understanding of biology with AlphaFold, which has the potential to radically accelerate the time frame of new proteins and potential breakthrough medical treatments. So there is just immense, incredible stuff that you see going on here with Google. So how much are you paying for all of this? I mean, that's the question that a lot of investors are asking. Like, is it actually cheap like I alluded to? Let's first do a quick plug, where if you're interested in joining a community of fellow investors looking to learn and find exceptional companies, we have an exclusive community on Discord. You can also sign up at unrivaledinvesting.com, click join the journey. I also call out potential multi-baggers and share my own personal portfolio for those interested. Also, if you enjoy videos like this, please make a point of hitting that subscribe, hit that thumbs up button. So Alphabet's core Google services business, predominantly online advertising, could be worth the entire market cap, given effectively the rest of Alphabet, like their Google Cloud, their other bets, their $150 billion plus in cash, plus investments, away for free. How is that possible? So in 2022, Google services might generate around $280 billion in revenue. That assumes about $245 billion in growth this year, around some sort of teens level growth next year, 38% profit margins. Keep in mind they're currently around 38% profit margins now, and a 15% tax rate. That represents $90 billion plus in free cash flow. I mean, just think about how mind-blowing that is, the scale and amount of free cash flow being printed. For context, Alphabet currently has a $1.7 trillion market cap. So this means Google services alone is valued at 19 times free cash flow, or around a 5% plus free cash flow yield. I mean, this is relative to a world with 0% interest rates. So here it is. Investors are arguably getting a 5% cash accrual to you as a shareholder, likely through buybacks, where the share count will likely get reduced in the future. You're getting this 5% accruing to you, plus whatever the organic growth is of their core advertising businesses. And, that might be low to high teens rate. Maybe it's even high single digits, but just think about it. 5% yield plus that growth, that's automatically a compelling, return I would start thinking about. And then you have to factor in, well, is there any sort of change in valuation? Now, valuation can swing both ways. It can both be a benefit and it can hurt you. But I would argue when you're getting that 5% yield, it does smell pretty good. Now, look, anything can happen in the short term. Longer term, I like that sort of prospect of, okay, potential low teens growth plus 5%. This seems pretty compelling, given that it once again gives no credit to their cash and investments, other bets, or Google Cloud. And this is arguably part of the reason why I talked about in the last video that, look, you don't need to draw a line between value and growth. You can find both, and that's, I'd argue, what you're seeing here with Alphabet. And the reality is that as you start layering on assumptions for their other segments, it's easy to pencil out 18s or even mid-20s% compound annual return in the years ahead over, let's say, the next 5 years. And that's how I'm penciling it out. Now, keep in mind, this is the back of the envelope, and the stock price can go significantly higher or lower. For example, in an era of huge budget deficits and record debt levels, they are a natural target for increased litigation, taxes, and penalties, as their multi-trillion-dollar market cap creates a big target sign. And if I'm right, they'll have the potential to become, a further trillion-dollar company, maybe a $4 to $5 trillion company in the years ahead if they continue to grow and get effectively hold on to their valuation. And so, as I alluded to at the beginning, I strongly suspect we're entering a period of immense volatility with the risk of significant downside as the Federal Reserve considers tightening. So I'm not going all in. And so, you might see this and you go, wow, Daniel, this is nothing but upside. The reality is, look, there's multiple different scenarios. This is how I'm just penciling out what I'm thinking the upside is. If for any reason they aren't able to deliver on some of the assumptions that I pencil out here, and keep in mind that I save this sheet exclusively for my Journey subscribers. So if you want to download that, you'll check it out. If they don't execute on these assumptions, of course, the stock price could go way lower. That's why I'm penciling out what is a reasonable set of assumptions. And so, look, that's why I'm not necessarily going all in at this point, because folks are aware, yes, the Federal Reserve is tightening. You're potentially looking at multiple rate hikes this year. This is an incremental bet, one of a few I've made recently, intending to take advantage of the recent weakness in the markets. Google's business is tied strongly to the US and global ad markets. So not only do you have the potential litigation, tax changes, what have you, folks targeting them, but if there's also a period of economic contraction, I have no doubt that it would hurt their growth and valuation multiples in potentially the months and potential years ahead. That said, I'm also looking at this and saying, well, wait a second, this type of business does have sort of inflation protection. So if you do go through a period of currency debasement, this is a good company to own from that perspective. On the flip side, they could get hurt from valuation multiple contraction. So investors need to be prepared for volatility. It's going to be up and down, and that's part of the appeal of owning something where you either have high confidence on a high growth rate, or you're saying, hey, maybe the growth rate's a little bit lower, but I'm very pleased to be getting a nice cash flow in the meantime. Personally, it wouldn't surprise me at all if Google stock traded much lower, much potentially lower in the next year or two. I'd actually welcome that. And this is a key reason that I think a lot of investors miss over time is that, like, I personally love looking at investments where I'm saying, yeah, this company is generating so much free cash flow, and management is astute enough to recognize what a good deal, their stock potentially is, and they're not issuing stock when it's, cheap. They're buying back in when it's cheap, and they're issuing it when it's inexpensive. I'm looking at this type of company. Management seems super prudent, and I think looking at this, if the stock price were to fall significantly, I strongly suspect Ruth Porat and the management there would be buying in tons of stock, reducing the shares outstanding, which would be the prudent move to do. So I'd say long-term investors should welcome the near-term volatility that arguably these months and years will bring in. And this is the type of environment that separates the haves and have-nots. And maybe I'll do a whole separate video on this. Is there are some companies that they have robustness. They have the anti-fragile business model where they can take advantage of volatility in their stock price by buying it in, having tons of free cash flow or having the cash on their balance sheet. There's the have-nots where it's like, oh man, we're going to have to raise capital in the future. They're in a much more vulnerable, fragile position to think about. So this is a whole separate, you want to think about, do I have haves, have not, in my portfolio? Why am I making these sort of trade-offs? I personally do consider things like that. It's not always going to be, tons of free cash flow, but if I'm going to make a trade-off, I'm going to want to say, okay, this company, has tons of growth potential, or I really like the valuation or something like that. So anywho, if this video has been helpful for you, please make a point of hitting that thumbs up and hit that subscribe button. Thanks so much for tuning in.